Good morning once again. Welcome to the Genghis Weekly Investor Briefing. In this briefing, we take you through the key events of the past week in the financial sector, that is from the fixed income, macroeconomics, and the equities segments. And with us today, we have our very own Melody Ndanu and Wesley Manambo, who are going to take us through the presentations today. And should you have a question, kindly direct it to the Q&A section, and it will be answered at the end of the presentation. Now, for the new participants, we welcome you. And for those who have been here before, welcome once again. Okay, over to you, Melody.
Thank you, Dalian. Good morning, everyone. Just give me one moment to share my screen. I believe you can see it now.
Yes, we can.
Okay, thanks. So we'll start off with the macroeconomic review. So the budget policy statement was released, the draft budget policy statement was released in the week. So this is in line with the Section 25 of the Public Finance Management Act. So it requires the National Treasury to seek and take into account the views of stakeholders and the public in preparing the budget policy statement. So generally, it's going to express the economic priorities, the structural reforms, and the sectoral expenditures for each program, which is implemented in the medium-term expenditure framework. So just delving into the 2022 BPS, it's pointing to an 8.8% increase in the total expenditure. That's to 3.29 trillion from 3.03 trillion in this financial year. So ordinary revenue is targeted to come in at 2.1 trillion shillings in FY 2022-23. That's a 20% increase from this year's target. So this could signal that the government will either increase its tax base or increase current taxes so as to hit the targets. But also they had noted that they're going to focus more on tax compliance and minimizing tax evasion. So they also noted that because of the progressive reopening of the economy and the uptake of COVID-19 vaccine and the increased demand for imports and improved domestic sales, we're going to see some uptick in the tax collected in the year and also in the coming year. Ministerial appropriation in aid is expected to stay at around the same level at 263.7 billion. Moving on to development and net lending, it's set at 712 billion. That's 14% increase year on year. As the government focuses on funding programs aimed at boosting economic recovery, as well as achieving the Big Four agenda. So net foreign financing is expected to hit about 363 billion as the government eyes a fifth Eurobond in the next financial year. So it's targeting about 105.6 billion shillings in the next fiscal year. And also the National Treasury noted that it is now ready to issue, the framework is ready to issue a green bond. So you might see that coming into play as well. So the government is aiming to reduce its domestic borrowing with a target of 483.1 billion. That's 26.6% lower than the current financial year. As it seeks to contain its ballooning debt. I've seen that now the gross debt is going to hit about 9.4 trillion in the next financial year, which is going to be above the 9 trillion shilling that had been set. Though the Treasury had announced earlier that Kenya will be raising this debt ceiling to accommodate gaps in the expenditure needs. So the ceiling for the executive has been set at 2.2 trillion. That's 6.97% higher than the current year. For the judiciary, it's about 5% increase to 18 billion. So looking at the ministries, it's the education sector that has the highest allocation at 525.9 billion. Mostly to do with the implementation of the CBC, that's the new syllabus and construction of new classes. So now after that, it's followed by ICT, public administration, and then national security sectors. Interestingly, the agricultural sector is going to receive 11 billion less, And this comes at a time when the country is facing some famine conditions. So we're going to see how the government is going to support that. So given the expenditure rationalization and the recovery trajectory, so the fiscal deficits, inclusive of grants, is targeted to decline from about 1 trillion in this financial year to about 862.7 billion. That's 6% of the GDP. And then it keeps going lower, 3.8% of the GDP in full year 25-26 to 743 billion. So something else that we noted from the draft budget policy statements, it gives a preemptive look to the first supplementary budget for this financial year, which is expected to drive up expenditure and net lending to about 3.15 trillion from the approved 3.03 trillion. So mainly it's the MPs are supposed to approve additional spending, additional 124 billion, mainly because current expenditure is expected to rise to 2 trillion from 1.99 trillion, mainly due to increased payments of local debt. So as you can see, debt payment and maintenance is a big issue. So domestic interest charges are expected to rise from 479.2 billion from 421.9 billion. And foreign debt is expected to drop to 126 billion from 138.4. So this first supplementary budget has been necessitated mainly due to the economic stimulus program that had been announced, so which includes the 10 billion in the third phase of Kazi Mtaani and the farm fertilizer subsidiaries, as well as other projects that the president had announced on Mashujaa Day. So something else, net financing is expected to spike to 1.029 trillion from 929. And these estimates are supposed to be tabled in the National Assembly ahead of now the ultimate passing of this legislation. So something else to consider is the Treasury has also raised the target for excise duty in this financial year. So mainly this is behind the back of longer operating hours by entertainment avenues, as well as increased rates of taxation. Seeing that there's the inflation adjusted tax that's supposed to be, that's going to come into effect. And this is supposed to give a boost to excise duty collection. So that's also going to be taxed on things like beer, bottled water, juice, borders. And however, petroleum products were removed from this list according to a pending court order that had been given by the High Court. So we can move on to the revenue that was collected by the government in the month of October. So cumulatively, the ordinary revenue stood at 577.3 billion. That's 548.4 billion in tax revenue and 28.9 billion in non-tax revenue, respectively. So this for October, the tax revenue grew about 28.6% year on year and 31.6% month on month. But though it's a bit below the average of 142.2 billion in the year. So against the 4-month 2021-22 figures, the run rate is about 96.4%. So the actual is 569.1 billion versus the prorated amount. So basically, it shows that there's a bit of a deficit of about 21 billion in the current year. So tax collections, as we mentioned before, mainly the KRA has seen some improvement due to the economy gradually opening, coupled with enhanced compliance. The recurrent expenditure, it's total 343.3 billion, and development and net expenditure total 101.4 billion. So both of them are below the target that has been set by the Treasury rather. On monthly basis, the net exchequer disbursements to recurrent and development spending rose to 86.9 billion and 19.5 billion respectively. against the previous month's disbursements. So cumulatively, servicing of public debts, it rose to 323.1 billion. That's about 55.9% of the ordinary revenue, just slightly below 65.9% target for the full year 2021-2022. So moving on to the fixed income segment. So market turnover hit 10.6 billion shillings. That's a 40.9% week-on-week fall, mainly on tighter liquidity in the market. So market activity was mainly dominated in interest in the infrastructure bonds sector, infrastructure bond segment, as well as the longer end of the yield curve, which has been just the running theme this current year. So this week, the IFB 2009-12 is coming up for redemption. That's actually today. This, coupled with the payment of 3 other bond coupon payments, is seen to at least boost the liquidity a bit during the week. So in the T-bill section, performance declined from 131.14% to 108.64%. So the total bids received came at 26.1 billion with 23.3 billion accepted. Looking at the performance of the T-bills, the 91-day T-bill recorded the highest performance. That's 209.94%. Just goes to show that investors are favoring the shorter term discount security compared to the others. So looking at the yields, on average, they increased across all tenors. Moving on to the liquidity. So the interbank rates, lending rates, it went up by about 51 basis points in the week to 5.2%. Just highlighting the higher liquidity that has been in tighter liquidity levels that have been in the market compared to the previous week. However, when you look at the daily rate, we've seen that it's been declining marginally, and we've seen some improvement in the week. So as at the start of the week, it was about 5.36%, but by the time the week was closing, it was about 5.07%. So just a bit of improved liquidity. In terms of CBK's open market operations, it mostly stayed out of the market in the week, and it mopped up about 6.5 billion shillings at the end of the week at a weighted average of rate of 4.886%. Looking at domestic borrowing, about 346 billion. Yes, 346 billion. That's inclusive of the CBK overdraft. So just goes to show that government is a bit ahead of the curve. So right now, the prorated amount is about 278.6 billion. So that's 52.5% performance rate. So from the supplementary budget proposed in the budget policy statement, it's going to seek that it's reduced to 616.8 billion from the current 658.5 billion. Looking at the macroeconomic calendar, so the 91-day, 192-day, and 364-day T-bill auction will be on the 25th of November. And so we are anticipating an update on the December primary auction prospectus this week. Historically, I think the MLF would have sat last week. So this would give us more color into which papers will be on offer for December. So looking at the fixed income trade for the week, so we recommend a range of 13.35 to 13.4 range levels for the FXD1 2019-20. So this 20-year paper is currently trading at a discount, which is an advantage to investors because they can acquire it cheaply because it's trading below par. So its coupon rate is about 12.87, and this is lower than its implied yield. So a few reasons why a bond can be trading above or below its par value. It could be that because of supply and demand, either because the bond is about to be called or just generally due to changes in prevailing market interest rates. So I will hand over to Wesley to take us through the equity segment of the week.
Thank you, Melody. Good morning to you. Investors with bearish sentiments drove activity during the week as signaled by the benchmark indices week-on-week performance. Nairobi Oil Share Index dwindled 1.8% week-on-week to settle at 168.43 points, while the NSE 20 share index shed 1.4% week on week, closing at 1893.65 points. That said, activity dropped in the market on a week on week comparison to a turnover of 2.5 billion. Looking at the week's gainers and losers, HF Group led the pack of the week's top gainers for the second week on a 18.1% week on week rally. Uchumi, Express, Home Africa, and General gained 14.3%, 8.6%, 8.1%, and 7.7% week on week respectively. On the flip side, Nairobi Business Ventures led the week's laggards, shedding 28.4% during the week. East African Portlands, Kakuzi, KPLC, and Scan Group shared 10%, 7.2%, 7.1%, and 6.2% week on week respectively. Looking at foreign participation, foreign investors accounted for 48.1% of the week's turnover. They sustained a bearish outlook. They exited Safaricom, KCB, and EABL while accumulating on equity and NBV to clock net outflow position of 322.4 million. Looking at the sub-Saharan market performance, the Nairobi All Share Index dwindled below its select peers on a week-on-week median comparison. And in our week's corporate calendar, we have the book closure for Kabasid's 1 shilling and 60 cents dividend, which will be on the 26th of November. Stanchard's 5 shillings interim dividends book closure will be on the 7th of December, and Kengen's on the 16th of December. To you, Melody.
Thank you, Wesley. So I'm just going to have a look at the financial sector highlights. So looking at the share price performance for the banking sector, as Wesley had mentioned, the HF Group led the pack at 18.07% rise. Mostly, we believe it's still investors reacting to the news of HF announcing a search for a strategic investor, and it could be the reason why the prices have been pushing upwards. Looking at ABSA as well, it went up 2.94% to close at 10.5 shillings and 50 cents rather. And it could be on the back that the results are supposed to be released on the 23rd of November, that's tomorrow. Stanbic Holdings just went down a bit by 2.39% to close at 91.75. That mainly that's range bound trading. As well as BK Group went down 5% to 26.9. Cooperative Bank declined about 2% to 12.3. It could be that the market was not, let's say, as impressed with the results as with the other banks that have been releasing, as well as the fact that Coop Bank has increased their loan loss provisions while other banks have been reducing it. However, each bank has a different strategy on how their credit policies rather. So this could just be that Cooperative is taking a more or less conservative approach compared to KCB and Equity. Looking at insurance sector, most of the counters closed in the red, with Liberty, the only one that went up by 6.27% to close at 7.46. Yes, so I'll just look at the highlights. So bank shareholders surprise payday as lenders declare late dividends. So we've seen that Standard Chartered Bank Kenya and KCB Group have defied the tradition and issuing dividends of about 5 shillings per share for Standard Chartered and 1 shilling respectively for KCB. So traditionally, banks have been issuing interim dividends in the second quarter. So they've backed the trend, and we've seen that the tier 1 banks, as from the quarter 1, quarter 2 results, they've been doubling their earnings as profitability in the sector just normalizes. And it also could just be due to base effect because last year was quite tough on banks. Besides the reduction in loan loss provisions, banks have rebounded their earnings by growing the operating income streams. And this is interest earnings from lending as well as from non-funded income. So as you're saying, KCB reduced the loan loss provisions by about 53.6%. and its expenses also reduced by about 15.2%. So you can see also costs rationalization comes into play in how banks are generating their profits. Standard Chartered, for them, earnings increased mainly due to non-funded income on the back of foreign exchange trading income, as more dollars are come into favor with importers, with the recovery of the economic outlook, more or less. So even though they had some NPL, the NPL ratio, the NPL, that's the non-performing loans ratio, worsened. They had some increased efficiency because of the reduction of their operating expenses. Secondly, banks' bad loans expected to ease in the next quarter. That's according to a CBK survey. That's the credit officer survey. So the respondents, we had touched about this last week, but we'll just go through it again. So about 41% of the respondents indicate that NPLs are likely to fall in the fourth quarter, and mostly due to improved business environment and enhanced recovery efforts. However, about 26% are still expect NPLs to rise, mainly due to the continued COVID-19 pandemic, while another 33% just expected it to stay constant. So though right now the NPL ratio is still above the pre-pandemic levels, but it's improved a bit. So it's gone down. In August, it's gone down to 13.9% compared to 14% in June. So just breaking down further into the report, it stated that pre-tax profits in the 9 months to September grew 63.1%, overtaking the actual full year 2020 earnings. So that just goes to show that even as the fourth quarter is coming up, the profitability of banks, it's rebounded more or less in this financial year. However, quarterly, the profit before tax decreased by 1.45 billion, and it was attributed to a higher increase in expenses as compared to income. So looking at sector-wise, respondents expected that the NPL ratios should remain constant in the 10 sectors or remain unchanged, but the trade sector still has a bit of an issue. So banks are expected to intensify their credit recovery efforts. We're going to see some more maybe auctions for the distressed borrowers, and also just generally they're looking to improve their asset quality as the year progresses. So credit standards remained unchanged for 8 economic sectors and tightened in 2. That's tourism and real estate. And mainly it can be just because of the way the pandemic has affected these sectors. So banks are shielding themselves from potential loss. Liquidity as well decreased slightly from 56.8% to 56.7%, but it's still way above the minimum ratio of 20%. So as you see, banks are still relatively liquid and they're still investing in government securities. Lastly, digital lenders bar borrowers on CRB freeze. So it was reported that digital lenders now will no longer give loans to new customers outside their existing database. And this is because of the continued freeze from the CRB. So this move is likely to deny a majority of borrowers short-term loans. So current rules bar the unregulated digital lenders from blacklisting defaulters, and they can only access credit information from CRB. So this self-imposed ban by these digital lenders is going to limit their growth as well, because now they can't share information amongst each other to say to check who has defaulted, who has not, comparing with each provider. It's not possible, especially due to the Data Protection Act that came into play. So that limits how much data can be shared with third parties without consent. So this moratorium is set out to last until September next year. So CBK had warned, actually, when it was implementing this moratorium, that it could restart rationing of loans. As you saw what happened that time when the bank caps, the interest rate caps were put in place, private sector credit growth was affected. So this could as well affect credit to the private sector. So lastly, just looking at the equities trading idea for the week is accumulate on KCB. So this recommendation is on the back of its improved performance and as well as its regional diversity play. So besides the acquisitions in Rwanda and Tanzania, KCB is also interested in acquiring a bank in DRC, where foreign exchange trades have been a major source of revenue for lenders. So it's also its interim dividend announcement is a boon for income investors. Additionally, the counter is poised for growth, so it can give customers the potential of capital gains just from the share price appreciation. And that's the end of our presentation. But we'll just go through day trading in a few minutes. Maybe Wesley can start us off, then I'll come in and fill in the rest.
Okay, let me lay the groundwork, then you build from there. So day trading is expected to go live today. Day trading is simply a form of share dealing in which traders buy and sell a financial instrument within the same day in an attempt to profit from intraday price fluctuation. So essentially, day traders seek to gain an edge on market inefficiencies in regards to the market's lag in pricing in prevailing market condition. It's also important for investors to know that to break even, the margin realized should be equal to the transaction cost, which implies that the actual gain is a numerical deduction of the back and forth transaction cost from the buy and sell margin. That said, day trading requires well-informed strategies and trading discipline that is in check to hedge from psychological biases like the decision fatigue, mental accounting errors, hindsight bias, and hard behavior, which a favorite author of mine likens it to the lemmings, which just follow one another. In essence, what it means when people are buying, you find yourself buying. When people are selling, you find yourself selling. And I'm sure M has something in store for us in regards to these strategies. It also goes without saying that intraday trading is not a part-time affair, as it takes time, focus, dedication, and specific mindset. The trading involves making fast decisions and executing a number of trades for a relatively small profit every time. It's generally thought of as the opposite of most investing strategies, which seek to benefit from price movements over a long period of time. In the equity market, it's also common practice to close out positions at the end of the day to avoid what is known as a gapping risk. This is when overnight news and influences cause a company's share price to open significantly higher or lower than the previous day's close. There are a few key factors to consider before you start day trading, and this include liquidity. The liquidity of the market is how easy and quick positions can be entered and exited. High liquidity is extremely important for day traders, as it's likely for them to execute multiple trades throughout the day with the ease of entry and exit. Another thing is volatility, and that's how rapidly the prices move. Or you can look at it as the ease of the prices to price in the prevailing market condition. If there is a high volatility expected during the day, the movements can create a lot of opportunities for short-term profits. And finally, trading volumes, another thing to watch. And this is a measure of how many times an asset is being bought and sold in a given period. A high trading volume shows that there is a lot of interest and is usually useful for identifying entry and exit points. Can you add some strategies?
Thank you, Wesley, for that introduction. So we'll just look at a few trading strategies that an investor can use for day trading. So one is high frequency trading, though this is mostly used by computer savvy or tech savvy individuals. That's mainly because they use automated algorithms to trade securities in high amounts as fast as possible. Secondly, news-based trading, just following how which news has affected the price of the stock and just trying to see how this news will affect the stock, and then now just buying and selling actions on that information. Another trend is mainly using trend trading. That's where traders attempt to make money by studying the direction of the asset prices, then buying and selling depending on which direction the trend is taking. Another one is called scalping. These are just theoretical. So it's a short-term trading strategy where you take small but frequent profits, but you mainly focus on achieving a high win rate. So the theory is that you can just as easily build a big trading account just by taking smaller profits time and time again. So there are some advantages and disadvantages of day trading. So advantage number one, no risk is associated with holding a position overnight. That's because day traders usually close out their positions before the close of each day. So they don't need to worry about overnight news events causing the market to open substantially lower. Yeah, so those are just some of the things. Then generally, it takes less time to generate substantial profits. So there were some questions that Peter had asked about withholding tax on capital gains tax. So capital gains was suspended on shares in 2016 after it was reintroduced in 2015. And so the transaction fees are going to stay the same with the exception of a 5% discount on the NSE levy. So day trades will receive a discount on the second leg of the transaction. So it will be about 0.114% compared to normal trades. That's about 0.12%. So on the T+3 settlements, because the trading is supposed to commence today, so that will be firmed up once the trading actually commences. But for the CDSC leg, the settlement will reflect on the same day. So the NSE had commissioned a system that will enable the separation of trading and post-trading activities. So the separation now will enable the introduction of this day trading and covered short selling. However, on cash settlements, according to the NSE, it's T+3, but as we said, it will be firmed up once actual trading commences. Then we can give you a better feedback on that. I've seen there was a question about which counters are likely to profit. I would say mainly the counters with high liquidity. In our view, but because we haven't really looked into it, we'll give much insight into that later.
Okay, thank you very much, Melody, for the presentation. And also Wesley, sorry, a few questions have come in. It being day one of day trading, Kamau is asking, are there any tips for a rookie? Like which counters are likely to profit from day one trading?
Sorry, Kamau, we haven't done analysis on this, but we should have our feedback in the next webinar.
Okay, thank you very much, George. Eric Ombok is asking, the shilling has been weakening against the US dollar in the recent week. Any reason and the outlook for the exchange rate?
Eric, it's a global strength. The USD strengthening globally. If you look at the USD index, it's strengthened a bit over the last few months. And the second thing is public sector activity, which is related to debt repayment. If you look at the latest statistics, debt repayment, external debt repayment, been a huge demand driver for foreign currency in the local. It's nothing to do with the private sector. It's a combination of those two.
Okay, thank you very much, George. George is our head of research at Genghis Capital. Maurice Robert is asking, will Genghis reduce or eliminate the brokerage fees? This is the only way day trading can be effective. Well, given that it is day one, I think we'll have to see first. This is entirely, the brokerage fees is determined by, it's constant through all brokers. And I think now this one will have to maybe talk to our management, and so that we can have maybe a comprehensive answer to this. Or I don't know whether Wesley, Melody, do you have any idea?
There's no way Genghis can eliminate brokerage fees. That's the purpose where Genghis exists, provide that intermediation at a fee.
Okay, thank you very much, George.
Daniel, let me jump in because I'm seeing Vinny here saying we charge 100 bob monthly. Why? We charge 100 bob plus VAT. It's actually 114 shillings monthly, but we charge it on the months you trade. So it's not that we charge you a standing charge whether or not you don't trade in shares. We only charge you when you trade in your account. So 114 charged per month for trading in your account is the rate that Genghis offers. Thanks, Dan.
Okay, thank you very much, Damaris. Kamau, you've raised your hand. Let me allow you to ask your question live. Go ahead, Kamau.
It was by accident.
Oh, okay. Okay, so okay, thank you very much for setting your time to attend this webinar today. Should you want to execute your trading ideas, you can do so via our application that is called Jikuze, which is available both on the Apple Store and the Google Play Store. And while at it, you can also be following Genghis Capital on our social media platforms as we update regularly on the key events and news from our company and the financial sector at large. And see you in the next week. Thank you very much.